There has never been a better time to own your own business because the newly passed tax bill provides a number of huge tax incentives specifically designed for entrepreneurs. It has enhanced and renewed several tax deductions, tax credits, and other tax benefits that will allow these individuals to grow their businesses while paying very little money in taxes along the way. And the people who fully understand these new tax provisions will stand to benefit from them the most. So in this video, I am going to break down the top 5 tax breaks in this bill for business owners as a licensed CPA that is already using these strategies every day for my clients at mycpacoach.com. If that sounds good to you, please hit the like button below, comment your thoughts, and let's go ahead and jump in. Okay, let's start with one that is already getting a lot of attention from business owners, like number 1, the 100% vehicle tax deduction. So imagine writing off the entire cost of a new vehicle by simply using it in your business. Well, the new tax rules will allow you to do this, so let's go ahead and break this down. First, please understand that the tax law is already very clear that if you use your car for business purposes, you can deduct it on your taxes. So if there is a legitimate business purpose for using the vehicle in your business in the pursuit of income, then you may be eligible to write off that vehicle on your taxes. Now, business purposes will vary for every person watching this video. It may involve traveling to meet with clients, customers, vendors, or even your own employees and business partners. It may include traveling between multiple business locations. Maybe you have multiple offices, multiple work sites, real estate properties, storage units, warehouses, and so on. It can include travel to those locations as well as travel to pick up things like office supplies, tools, equipment, inventory, or other materials. But the bottom line is that you must use your car for business travel, which is typically defined as traveling from one business location to another business location. That's step 1 if you want to write off 100% of a vehicle. Step 2 is that vehicle must also be eligible for 100% bonus depreciation, which the new tax bill just renewed and put into place for all eligible purchases made after January 19th of 2025. But here's the thing with 100% expensing of a new vehicle. Your deduction may be limited if it is what the IRS defines to be as a passenger automobile. And the IRS generally defines this to be a 4-wheeled vehicle that weighs less than 6,000 pounds, which means if you purchase a business vehicle that weighs more than 6,000 pounds, your purchase may not be subject to those limitations, and you may therefore be able to write off 100% of that vehicle with bonus depreciation. The last time bonus depreciation was 100%, we saw influencers purchasing G-Wagons, Range Rovers, Model X's, and other heavy vehicles because those purchases granted them larger tax benefits. And then it's just a matter of using the vehicle more than 50% of the time for your business, which is step 3, and this is required in order to use bonus depreciation. And if you qualify, only the portion of that vehicle that is being used for your business will be eligible for the 100% deduction. For example, if you use the vehicle 100% of the time for your business, you can write off 100% of it on your taxes in most cases. If you only use the vehicle 50% of the time for your business, then your deduction will be limited to 50% of that vehicle's cost. But this tax bill is packed with many more tax benefits than simply writing off a vehicle, so let's go ahead and move on to tax break number 2, the enhanced QBI deduction. The new tax bill extended and enhanced the QBI deduction, made it permanent, and even increased the income phase-out limits, which will allow more people to qualify for this. Now, if you don't know, QBI grants a 20% deduction against qualifying business income for simply being classified as a business owner, and even independent contractors qualify for this as well. So someone with $100,000 in qualifying income could instantly write off $20,000 on their taxes with this deduction, or $80,000 if they earn $400,000 in income. And by default, single taxpayers automatically qualify for the QBI if they earn less than about $200,000 in income and less than $400,000 for married taxpayers if they have business income. But once you earn above these ranges, this deduction phases out for certain types of businesses, specifically those classified as a specialized service, trade, or business, like doctors, lawyers, accountants, actors, musicians, and other professions where the principal asset of that business is the reputation or skill of one or more of its employees. The new tax rules will increase the phase-out income limits for these types of businesses by $75,000 for single taxpayers and $150,000 for married taxpayers starting in 2026, allowing these businesses to take a partial QBI deduction when they are in this range. And since this provision is permanent this time around, it will allow these businesses to be comfortable making changes to their overall business structure that may allow them to qualify for the QBI deduction. For example, some of these businesses may be able to separate the specialized portion of their business from the non-specialized portion, allowing them to take that 20% deduction against the non-specialized portion. Now, if that sounds complex, I've already published a separate video that goes into that in greater detail, so make sure you subscribe and check that out if you want to learn more. But for now, let's move on to other big tax benefits in this bill, like tax strategy number 3. Income shifting strategies, which will ultimately allow certain business owners to shift income to destinations that are taxed at lower rates, like to their own family members or even other entity structures. So there are two big things that this bill does that business owners will be able to take advantage of. Number one, it makes the increases to the standard deduction amounts permanent, which is nearly $16,000 for single taxpayers and $31,500 for married taxpayers, which may allow business owners to hire their family members and pay them up to these amounts without those family members having to owe any income tax, because it would be essentially wiped out by the standard deduction, assuming they have no other income anyway. But when this is done correctly, this would allow the business owner to write off the amount it pays to that family member on their business taxes, while the family member can use the standard deduction to avoid paying tax on the amount that they receive. Now, there is some nuance to this, so if you want to learn more about this strategy, just comment kids. But the second big thing you need to know related to this that the bill does is that it also maintains the 21% corporate tax rate, which may allow business owners who are in very high tax brackets right now, like 35 to 37%, to either A, switch their entire entity over to a C corporation to pay lower rates of taxes, or B, shift some of their income to a corporation they control, like a management company, for example, to pay lower rates of taxes. Now, this works well when there are plans to leave money in the business to reinvest into other things in the future. It does not work well if you are simply going to withdraw those funds out of that corporation because you may trigger double taxation, like dividends, for example. Now let's move on to another huge tax break for business owners. And number 4, 100% R&D expensing, which can be claimed in addition to the R&D tax credit. This will allow taxpayers to get 2 tax benefits on the same expense. So let's break this down. First, imagine writing off 100% of an expense and then being able to claim a tax credit related to those same expenses as well, putting even more money back into your pockets. And that's basically what is possible here with research and development expenses. The new tax bill allows 100% expensing of R&D expenses, which are expenses related to developing or improving any product, process, technique, formula, or software in your business. And the expenses you can deduct related to this include wages paid to your employees or fees paid to contractors or agencies helping you with this, plus any supplies and related research expenses that you may have had in the year that you paid it. And instead of these costs being deducted over several years, which is what it was before, you will be able to write off 100% of these expenses in the year that you paid it and incurred those expenses. Then on top of that, we still have the R&D tax credit, which allows you to claim a tax credit against those same expenses up to 20% of the amount, depending on the method you use. Now, there are several IRS rules and adjustments to consider when you are using both of these methods together. But in most cases, you will save more money in taxes by combining these things. Just comment R&D below if you are interested in an in-depth guide on this. But for now, let's go ahead and move on to another big tax benefit in this bill. Number 5, the Opportunity Zone tax break, which can be used to avoid capital gains taxes. So look, anyone expecting to have a large capital gain at some point in the future, whether it is from selling a business, selling crypto, stocks, real estate, or other investments, this may be very beneficial. So here's how it works. In short, the government has designated opportunity zones that they want to invest in to spur economic growth in those areas and create jobs. So they use this as a tax incentive to get investors to invest into businesses or real estate projects in those areas. And when they do, those investors are able to, one, defer their capital gains for 5 years if those gains are rolled into a qualified opportunity zone fund within a certain amount of time. And then two, if they hold their investments in those funds for at least 10 years, they will pay no capital gains on the gains related to the opportunity zone investment specifically. It will be permanently excluded at that point from being taxed at all in the future. Now, to qualify for this, you must first invest into what is called a qualified opportunity zone fund, which you can even create and manage yourself if you would like to, or you can find one to invest in passively. And for anyone seriously considering this, then please be aware that these new rules for opportunity zones specifically kick in starting in 2027. For opportunity zone investments made before this time period, your initial capital gain would actually be recognized in 2026 under the old rules, but you may still benefit from the capital gain exclusion from the fund itself if you make that investment and hold it for 10 years. Just comment OZ if you want to learn more about this. But ultimately, if you are seriously considering any of the strategies covered in this video, then make sure you are working with a CPA that fully understands the ins and outs of these strategies. And if your CPA is not working with you year-round to do this and keep your taxes down, just apply to work with my team today at mycpacoach.com.